Talking about the markets, well, we've seen again the Wall Street going back to its wild slide once again. After watching the stocks march higher for so many years, investors are suddenly confronting a new reality. Nikunj, why is this massive sell-off happening, and what should investors really do at this point of time?
Karanya, I like the excitement in your voice, but frankly, if you're a bull, the excitement clearly would be missing today. Now, it's been a wild few days for the stock markets, yes. But does wild mean this is worrisome? If you're a short-term trader, you would say that you need to get worried because the trend in the market has changed. I guess what's the reason why a 1,000-point fall on the Dow is now looking like a large fall is because we have seen a very smooth ride for stock markets in 2017. The fundamental concerns, I guess, for the stock markets haven't changed, which is US 10-year paper, growth making a comeback, inflation scare. So fundamentally in last 4 or 5 days, nothing has changed, but the way global investors are perceiving risk, the way they are now ready to approach leverage, that clearly seems to be changing. So there is a lot of talk of this financial Armageddon, but frankly, if I put things in context, given that where we were after a big rise, we've seen a very small fall. But in case you've just tuned in, well, the Dow saw a sell-off, but Dow futures are pointing to a right direction. The bond yields are at 2.8%, and crude is down to $60 per barrel. So if you're an India watcher, you would say, hello, the world may be folding up, but if crude is back at $60, do I need to be that worried about local inflation? So there is an unwinding which is at play. If bond yields is gravitating the way it has gravitated, the way cost of capital would move, it surely will have implications in the short-term market action. Now, I also want to point out what is in store for Indian markets. And when Indian markets, you got to realize that right now there is selling which has only intensified in the mid and the small cap stocks. And the reason why small and mid cap stocks are underperforming despite DI liquidity is because A, HNIs are unwinding, B, some of the mid cap stocks are still trading at multiples which are much higher than large cap stocks. So I guess it's a combination of A, weaker hands feeling the heat, and B, valuations in mid and small cap stocks are still not that still not all that great. Richard Harris now joins us, and Richard, it's been a few wild days for the stock markets, but does wild mean worrisome?
Well, I think wild means that, the markets had risen quite high. It's almost like building a mountain of sand, and the final grain was put on the hill, and the hill's seen a bit of a slip. We don't really know why. It's all part of the great magic of the markets. But clearly, the inflation story, the interest rate story, was something that made it go. But essentially, to my mind, they seem to be more like excuses for the market just needing to come back and consolidate.
Richard, how should one read into this so-called inflation scare? If inflation is making a comeback, that has to be accompanied by global growth. And I wonder why bulls are unhappy. Bulls should be celebrating that after a great 2017, growth is here to stay in 2018.
Well, actually, you put your finger on it. But I think what's basically happened is the market's moved ahead. It's discounted the likely growth that's coming. It's now starting to get worried about the likely inflationary aspects and interest rates going up. So I actually figured, even in the beginning of the year, that we might easily get something like a 12% pullback. Remember, this is a bull market, so a pullback of 12% actually takes us back to levels not seen that very long ago. So it would not be surprising to see that. But I think that there are so many positive pieces of news out there. You've got the Trump tax reflation that's important. You've got possible infrastructure bill coming through. You've got economic growth in Europe. Economic growth continues in the emerging market, coming through in China as well. So there are lots of positive news out there. And don't forget that if we are going to see a battle between inflation and interest rates, then inflation is going to win. By that I mean aren't going to be able to keep up with inflation moving upwards. It's not going to move upwards too much. But what's likely to happen then is we're likely to see real interest rates fall, and real interest rates falling are good for economies. So I'd say in the medium term, and we're talking maybe 18 months, the economic picture is quite good. But soon down the line, somewhere down the line, we're likely to have some sort of bigger pullback, but this isn't it.
Sandeep Tandon, my next guest, he's been calling for this market correction for a while now. In fact, in October, Sandeep said that US markets are nearing what could be called as a rather permanent top. And Sandeep, is your view still intact? And you are of the view that US markets have made a multi-year top and the bull market in US is over?
I will still maintain this thesis because our thesis was based on a couple of data points. One was we have talked about somewhere in the second half of 2017, around September, October, we talked about volatility expansion will happen, and this phase can go up to till 2020. The way the walls has come down to such low levels, people were so complacent about it. So we have our own theory on band expansion, how volatility band expands over a period of time. Based on that logic, we have predicted that volatility band will expand from 2017 till 2020. And maybe in 2020, you will see far bigger problem for other global markets, including emerging market. Maybe emerging market can survive right now. So concern which we had is about US market. We always highlighted the biggest risk in the global equities is about US top, and which we are not talking about multi-year top. We have said this will be a decade top. Okay, and we have been showcasing this is the biggest and last bull run in my life. That's the way we have been showcasing right from 2012, August 2012. And if you recollect, bond market peaked out in 2017, dollar index peaked out in the beginning of 2017, and US also peaking out. The risk is US, okay? But we are not expecting immediately like a scenario of 2007-8, which people are worried about it. My sense is that we have seen a sharp correction and can continue for a few more days, but then things will settle down and you see recovery coming back in maybe in the second half of 2018 for US market. And again, that again should be used to sell only because we believe that long-term top is in place. And in the short term, obviously, it will be a pain point for all emerging markets because US being the mother of all exchanges, when they correct, every market has its own pain points. But in long-term perspective, and I sort of look at both from medium to long-term perspective, I think Asia will outperform. Asia will decouple from US, whatever is happening. So it's a wait and watch approach right now.
Sandeep, we'll come to you for more questions. Richard, recent big corrections, or in past we have seen in 2008, or 2007, 2008, it was subprime which led to a big correction, and then you had subsequent correction. You had commodities correcting substantially, but this time, whatever volatility we are seeing, we are not seeing any rough patches which is leading to this correction. I understand people are worried about hike in interest rates, but there's no substantial reason for this market to correct. Do you think we should compare this correction with the previous correction when we had some solid reason for corrections?
No, it's quite different. I mean, we did have solid reasons, and we didn't actually believe them last time. So what you saw was when we had the very big falls in the market, what then was the biggest fall ever, 600-odd points on the Dow. We've just seen 2,000-point falls on the Dow, which shows how high the markets have gone up. But in those days, we saw those big falls after a significant period of market weakness and markets falling. It's very different now. What we're seeing is a big fall, yes, but we're in the middle of a bull market. So the two are quite different, I think, in terms of their tone, in terms of their sentiment, in terms of their character. So you can't compare, a fall of mere points to each other. You have to look at the whole market spectrum around it and how the behavioral aspects of the market as well.
That, whereas enough and more has been debated on, is this 2008 in making? Because the selling is so compressed and selling is so fast and furious that I've read a lot of financial blogs and a lot of financial commentators who are trying to somehow draw this silly parallel between 2008 and 2017 or 2018. And we should not go that far, Siddharth, because even though this may look like a financial Armageddon, but look in context. We've had a great rally for US markets for multiple years. After a big rise, this is a small fall. Also, like Richard pointed out, the context is very different. That, the reason why we saw sell-off in 2008 is because the word leverage was unwinding, and then there was a growth scare, and then there was a subprime market, and market never reacts to the same bit of news differently. So we are on the different end of spectrum, so to speak, this time. That time it was a growth scare, right now it's an inflation scare. All global financial markets need is some reassuring words from Fed that they will not be increasing rates for more than 3 times. We've not heard anything from US Fed. It is just that the spike in the bond yield is preempting everyone to come out with all kind of an assumptions. You never know what Fed wants. White House has already commented on the fact that they're worried about the stock market. So whereas I will not be in a hurry to say that this is like a mega reversal which has started. But yeah, in the short term, since their cozy trades are unwinding, which is your long US treasury trade is unwinding, it will have repercussions. It may have repercussions for 10 or 15 days, but yeah, this is not a parallel between 2008 and 2018. That's my sense. Sandeep Tandon, what should Indian investors do now? Should they buy the fall or wait it out? This market will unwind more and you will get better entry points.
I just want to add one more point since we are talking about comparison with 2007-8. See, 2008 was the crisis where suddenly liquidity got vanished from the system globally. Okay, where this time the all central banks have been working in tandem for liquidity, and this is a liquidity-related bubble which is unfolding right now. So I don't think that is you can compare, because even liquidity tightening is already started in the month of May 2017 in US market. It will be a gradual thing because central banks are still working together. So I don't see even any concern related to liquidity as compared to 2007. Yes, I agree. Inflation is one big worry which we have been showcasing for last 1 year. Inflation will come back and it will be much more than what the central banks are looking at. Okay, and we are more worried about agri prices. We have seen a bull market in the base metal earlier, bullion market. Now the next theme for 2018 is the agri prices will globally move up, which will spike the inflation further, and that will create problem at later stage. Coming back to the Indian market, we always said that whenever US market corrects, okay, it has its own psychological impact. My sense is that based on our quant liquidity indicators and quant risk appetite parameters, we think risk appetite is significantly low in Asia. And I'm talking about particularly in the current level, right from Japan, China, India. I'm talking about 3 large Asian markets. The risk appetite indicators are significantly low. In fact, they're below the equilibrium point, which clearly indicates we are not in the risky territory as such. Liquidity is gradually increasing. So after this impact, whatever we are seeing in Asia market will decouple from US. It might take 2 months, it might take 3 months. Okay, it's very difficult to pinpoint exact timelines, but I think India will decouple from US market. So buying on dip strategies should work for India, which is not the case for US. But if you look at as of yesterday also, over the fear index is still spiking. It has not yet to reach that level what we have seen in November 2016 or even earlier crisis. So somewhere we are very close to that event. Maybe another 300, 400 point Nifty can correct from these levels. So maybe 10,200, 10,300 can be retested. So that's the level. If around 10,300 level, I think one should be buyer in India stock from a longer term perspective.
Sandeep, I'm sure everybody on the street is waiting for that decoupling to happen from the other equity markets, from Wall Street especially. But what are some catalysts and triggers that you can point out that would lead to this decoupling and that would drive some kind of growth and kick in some kind of relief for the Indian markets?
So it may not be very visible trigger, because our thesis is, ultimately is all about liquidity. Okay, if US market has peaked out, and we believe that from developed market, particularly US, money will shift towards emerging market, and that trend we have seen last year itself. So it's not like now we are suddenly seeing that. It started last year itself. Even 5 to 8% or 10% money shifts from US market to Asia, that itself will be good enough for a big move in Asia. But that will not be a visible catalyst. It's like invisible sort of thing, which you will realize and feel only after a lag of few quarters or few months. Okay, so maybe in a week's 10 days time, you see a bottom happening in Indian market. And to really that momentum to build up further, that will require some time.